today's markets in general. Anthony DePaul from the APSEC joins us live from our Sydney CBD studio. Anthony DePaul, great to have your company on the program today. Let's talk markets first up because we're adding another 16 points today. As mentioned, above that 5,550 mark now. It seems like we've defied odds. We continue to defy odds. Where do you see markets going from here, though?
Yeah, correct. We've also had disproportionate gains in the domestic market relative to the US this week, and after 14 out of the last 16 sessions being in the green, not only are we overbought from that viewpoint, but also from a technical viewpoint, if you look at the relative strength indicator, we're overbought on that basis as well. So it is, in my eyes, it's a time for the market to take a breather and a bit of profit taking as we lead into the reporting season.
Yeah, okay, because, I mean, certainly you wouldn't have expected, I guess, us to move this high, but it does all depend on reporting season, but does it also depend on that rate cut? If we see the RBA obviously cut rates and more stimulus added to the economy, certainly that could drive the market a leg up?
Yeah, well, we've got a greater than 50% chance of a rate cut in August, but we only have to look as far as May when the RBA surprised us and cut interest rates then. We only had about a couple of days of gains on the back of that decision. So I'm not entirely convinced that an additional rate cut will cause a massive increase in market prices from these levels. I'm only expecting the market to go up to around 5,600 points before we start seeing some profit taking across the board.
All right, well, looking, of course, at reporting season, which you mentioned, it is interesting and it certainly will be a driver for our markets. So what sort of strategy are you playing in the lead up to reporting season, or as reporting season really starts to kick off?
Well, we're actually using the strength of the current market performance to start taking some profits to de-risk positions before they report. So, you know, a lot of the banks are right at the top of their range, looking to take some profits in that sector, potentially after the RBA rate decision and before their trading updates. In addition to that, if you look at the energy sector, well, there's been a bit of positivity creeping in with some stability in energy prices over the last few months. So there are some companies in that space that we are looking at, Santos and Woodside in particular. And with the pullback in energy prices this week, it's making some of those companies more attractive before they report. And then we've got companies in the consumer discretionary space that will be helped by a potential RBA rate cut, and also, you know, petrol prices remain low. So we would expect that to continue to drive positive consumer sentiment and make some of those companies in that space well supported. So companies in the cafes, food and restaurant space like Retail Food Group, they own Gloria Jean's Coffee. Companies you know, like Tassal, they're not exactly a consumer discretionary, they're more in consumer staples, but we would expect that those companies to do well in that space.
And we'll talk consumer in a bit more detail in just a moment, because I know you've got some calls on some of the supermarkets, but BHP as well. Today it's been in focus, obviously, for other reasons. It's flagged a $1.1 to $1.3 billion provision over that Samarco disaster, which continues to, I guess, overhang on the stock. But certainly the iron ore price has been interesting of late. It's been continuing to rise, continuing to do pretty well despite the volatility. And we're seeing all the miners, or the major miners, I should say, up today, including Fortescue, which is up over 5%. Huge gains for it yesterday after its production results. Your take on the iron ore space, materials in general, and some of these majors, where are you sitting with investment strategies on them?
Well, iron ore has had such a great run over the last few months, and a lot of that's due to relaxed credit conditions in China, and that's really helped China's property prices in some of them have gone up by over 40% in 12 months. And when we look at the growth rate in property, 7 of the top 10 cities in the world come from China for the last 12 months. But there's so much heat in that part of the market, it's probably time to throw some cold water on that area of the market. And in terms of what it means for iron ore, as we go into the seasonally weak part of the calendar year, since 2011, iron ore has been on average about 11% weaker in the second half of the year. So we would be expecting a softening in demand for iron ore for the second half of the calendar year. In terms of what it means for some of the names in that space, well, You know, if you look at the consensus price targets for Fortescue Metals, Fortescue Metals is well and truly above those targets. And yes, they had a fantastic update in regards to their continued declining costs. You've got to take your hat off to management there for their ability to do that. But, you know, every stock has a price, and I think there is a bit of greed in the market at the moment, especially with Fortescue Metals, and at these prices it would make sense to, you know, take some money off the table.
Yeah, okay. I want to talk a bit about your strategy, because I know you're looking at the supermarkets, and everyone's sort of taken another look at them since Woolworths obviously came out with that news earlier in the week. And of course there is this sort of battle of those two, whether or not there should be a rotation out of what's been broadly seen as the better quality stock, Wesfarmers, into Woolworths as a turnaround story. Is that a bit sort of rich to see Woolies as a turnaround? How are you seeing these two at the moment?
Yeah, I agree. Like Ingrid, when you look at fund managers looking to get exposure to consumer staples, well, what do? They go either into Wesfarmers or Woolworths, and the fact that you know, the Masters program has really hurt Woolworths over the last few years has caused significant price drops in that name, and that's created a bit of a reallocation of capital away from Woolworths into Wesfarmers. But as of late, we've had a bit of debate as to where should capital go to in that space, and we see that Brad Banducci is really trying to do things to turn the business around, and you know, he's admitting to previous mistakes that management have made. So yes, they're looking to exit their Masters program. You know, potential sale of home timber and hardware business would be a positive, but we don't know the metrics of that sale as yet. And even if they do sell that part of their business, what does that mean for the retail side? Is that going to still stay on the market? Will they have to do a further write-down in that part of the business? There's a lot of question marks there, and also they came up with that announcement a couple of days ago that they're going to reduce the store rollouts and remove some of their underperforming stores. That was viewed positively by the market, but we disagree. If you have a look at reducing store rollouts, that's going to reduce your scale, and that's going to reduce your market share. And that's going to make it even harder for them to compete against Aldi's that are looking to grow their stores by 10% next year, and they've grown their stores by 25% last year. So that's going to have, in our eyes, an unfavourable impact on margins.
Yeah, it certainly is a tough story for the supermarkets at the moment. Lots of competition in that sector. We'll leave it there though, Anthony. Appreciate your time. Thank you.
Thank you.
Anthony DePaul there from APSEC out of our Sydney studio. I want to take